Welcome to the audiobook insights for The Warren Buffett Way, 30th Anniversary Edition, written by Robert G. Hagstrom. Introduction. 30 years is a lifetime in the financial markets. When the first edition of this book was published in 1994, the investment landscape looked radically different. There was no high-frequency algorithmic trading, no cryptocurrency, and the internet was in its infancy. Yet, here we are, 3 decades later, revisiting a text that has arguably become more relevant, not less, amidst the noise of the modern world. This anniversary edition is not merely a nostalgic look back. It is a reaffirmation of principles that have withstood the most volatile storms of the global economy. The central premise we will explore together is deceptively simple, but incredibly difficult to execute. Success in investing does not come from inside information, complex charts, or staring at a ticker tape all day. It comes from a mindset, a specific, disciplined way of looking at businesses and the markets that host them. Warren Buffett, the chairman and CEO of Berkshire Hathaway, is the protagonist of our study, but he is also the proof of concept. He is the living validation that rationality, patience, and a business-first approach to stocks can outperform the frantic speculation that defines Wall Street. Why do we need to study Warren Buffett today? One might argue that the world has changed too much. We live in an era of artificial intelligence and immediate gratification. However, the psychology of the market has not changed. Human nature, driven by fear and greed, remains constant. Because human nature drives market prices, the opportunities for a rational investor remain constant as well. Buffett's method is the antidote to the chaos. It is a framework that allows you to shut out the noise and focus on the signal. In this deep dive, we are going to deconstruct the man, the method, and the math. We will look at how a young boy from Omaha, Nebraska, obsessed with numbers, evolved into the oracle who guides billions of dollars of capital. But we are not just telling a biography. This is a methodology course. We want to understand the chemical composition of his decision-making process. We will start by examining the personal history that shaped him, specifically the 3 intellectual giants who molded his mind: his father, Howard Buffett, his mentor, Benjamin Graham, and his partner, Charlie Munger. We will see how he took the strict value investing of Graham, buying dollar bills for 50 cents, and merged it with the qualitative genius of Philip Fisher and Charlie Munger, who taught him that it is better to buy a wonderful company at a fair price than a fair company at a wonderful price. This distinction is critical. It marks the evolution of Buffett from a simple stock picker to a business owner, and that is the lens through which you must learn to see the world during our time together. When you buy a stock, you are not buying a piece of paper or a digital blip on the screen. You are buying a fractional ownership in a living, breathing business. If you cannot understand the business, you cannot value the stock. Over the course of this journey, we will break down the 12 immutable tenets that govern Buffett's purchases. We will categorize them into business tenets, management tenets, financial tenets, and value tenets. We will not just list them, we will apply them. We will look at his most famous acquisitions, the Washington Post, Geico, Coca-Cola, and we will also look at his modern evolution, including his massive stake in Apple. We will ask the hard questions. Why did he buy? What did he see that the market missed? How did he value the company when others were scared? We will also address the elephant in the room: active management versus passive indexing. For years, Buffett has advised the average person to simply buy an S&P 500 index fund.
Does that mean stock picking is dead? Not at all. It means that most people lack the emotional discipline to do it right. This book is for those who wish to cultivate that discipline, the focus investors who are willing to concentrate their bets on their best ideas rather than diluting their returns across hundreds of mediocre ones. Finally, we will discuss the money mind. This goes beyond accounting. It touches on temperament. Why do smart people do stupid things with their money? Why do high IQ fund managers underperform the market? The answer lies in emotional stability. Buffett's greatest edge is not his IQ, it is his temperament. He does not panic, he does not follow the herd. We will explore how you can cultivate this stoicism. As we embark on this 30th anniversary edition, keep in mind that we are looking for patterns. We are looking for the common threads that link a purchase in 1973 to a purchase in 2016. We are uncovering a philosophy that is as applicable to a small personal portfolio as it is to a multi-billion-dollar conglomerate. The goal here is not to tell you to buy what Buffett buys. That is mere imitation. The goal is to teach you to think how Buffett thinks. That is education. If you can learn to analyze a business with the clarity of Warren Buffett, you will have an intellectual toolkit that will serve you for the rest of your life, regardless of what the market does next. So, clear your mind of the daily headlines and the market chatter. Let us step into the world of rational capital allocation. Let us begin. Chapter 1. World's Greatest Investor. To understand Warren Buffett, we must first grapple with the sheer magnitude of his achievement. It is common to hear him described as the Oracle of Omaha, a folk hero of capitalism, or simply one of the richest men in history. But these labels, while true, obscure the statistical impossibility of his record.
For over half a century, Buffett has outperformed the general stock market by a margin that defies the laws of probability. In a world where efficient market theorists argue that beating the market consistently is impossible, Buffett stands as a colossal counterargument. He did not achieve this through high-frequency trading, esoteric derivatives, or leverage that risks ruin. He achieved it through a method that is transparent, logical, and, in theory, replicable. Yet few have replicated it. Why? Because the method requires a specific combination of intellectual brilliance and behavioral discipline that is incredibly rare. This chapter sets the foundation for our entire study. We are going to trace the arc of his career not just as a biography, but as a case study in the evolution of an investment philosophy. We will look at the patterns he recognized, his early entrepreneurial ventures, the structure of his initial partnership, and finally, the creation of the corporate fortress known as Berkshire Hathaway. Understanding patterns. Human beings are pattern-seeking animals. We look for order in chaos. In the financial markets, this instinct often leads us astray, causing us to see trends where there is only noise. However, for Warren Buffett, pattern recognition is the cornerstone of his genius. But the patterns he looks for are not squiggly lines on a price chart. They are patterns of business behavior, economic durability, and management integrity. Buffett's success can be viewed as the result of a continuous refinement of his ability to recognize the patterns of success in a business. Early in his life, he recognized that wealth is not generated by labor alone, but by capital, specifically compounding capital. The pattern is simple. Money makes money, and if you leave it alone, it makes even more money. Most investors react to the patterns of the market, prices going up or down. Buffett ignores these. He focuses on the internal patterns of the company. Does the company consistently raise prices without losing customers? That is a pattern of pricing power. Does management consistently return cash to shareholders or squander it on ego-driven acquisitions? That is a pattern of capital allocation. By focusing on these fundamental economic patterns rather than the chaotic patterns of stock price movements, Buffett effectively moved his game to a different playing field. While Wall Street was playing a game of speed and speculation, predicting what a stock would do in the next hour, Buffett was playing a game of durability, predicting what a business would do over the next 10 years. This ability to detach from the immediate feedback loop of the market and focus on the long-term feedback loop of the business is what we call the money mind. It is a concept we will return to, but know this: the greatest investor in the world is not the one with the fastest computer, but the one with the most accurate recognition of economic reality. The making of an entrepreneur. The seeds of this worldview were planted long before he ever bought a stock. Warren Buffett was by all accounts a prodigy of capitalism. Born in 1930, just as the Great Depression was taking hold, he developed a fascination with numbers and money that bordered on obsession. We must look at his childhood not for anecdotes, but for evidence of his intuitive grasp of business mechanics. Consider the Coca-Cola venture. At a young age, he purchased 6 packs of Coke from his grandfather's grocery store for 25 cents and sold the individual bottles for a nickel each. The profit was 5 cents per 6-pack, a 20% return on investment. This seems trivial, but it contains the DNA of his future empire. He learned about margins. He learned about high-frequency turnover. He could repeat this transaction as often as he could find buyers. He learned that he did not need to manufacture the soda. He just needed to be the capital allocator who moved it from a place of low value, the shelf, to a place of high value, the consumer. Later, in high school, he ventured into the pinball machine business with a friend. They bought a used pinball machine for $25 and installed it in a barbershop. The deal was a 50-50 split with the barber. The first night, they collected $4 in nickels.
Most teenagers would have spent the $4. Buffett did not. He recognized the power of retained earnings. He used the profits from the first machine to buy a second, then a third. He understood intuitively that capital is a tool. If you consume the seed corn, you have nothing to plant for next year's harvest. By the time he sold the business, he had learned a lesson that would define Berkshire Hathaway. The cash flow from one business should be used to acquire other businesses. He was constantly calculating.
He read books like 1,000 Ways to Make $1,000. He was not interested in money for the sake of luxury. He was interested in money as a scorecard and as a vehicle for independence. By the time he reached adulthood, he had already amassed a small fortune relative to his age, purely through entrepreneurial hustle and disciplined saving. He was already an investor. He just needed a formal structure. Buffett Limited Partnership. That structure came in 1956. After working for his mentor, Benjamin Graham, in New York, Buffett returned to Omaha. He had no intention of working for a brokerage firm where he would be forced to sell stocks to clients regardless of their quality. He wanted to manage money on his own terms. He started the Buffett Limited Partnership with 7 limited partners, mostly family and friends, and a total of $105,000. Buffett himself contributed only $100. The structure of this partnership is critical to understand because it reveals Buffett's obsession with fairness and alignment of incentives. In the typical mutual fund of the day, and even the hedge funds of today, managers charge a fee based on the total assets under management. If the fund is large, the manager gets rich, even if the performance is mediocre. Buffett rejected this. His ground rules were radical. He charged no management fee, 0%. Instead, he took 25% of the profits, but only after the partnership exceeded a 6% cumulative annual return. If he failed to earn 6%, he got paid nothing. If he lost money, he had to make up the loss in future years before he could take a fee again. This high watermark structure meant that Buffett only got rich if his partners got richer. He put himself in the same boat as his investors. He told them, "I will not tell you what we own or why we own it. You will see the results once a year." He demanded complete autonomy in exchange for this alignment of interest. The partnership years from 1956 to 1969 were arguably the highest return period of his career. He was managing small sums of money, which allowed him to invest in tiny, illiquid companies, what he called cigar butts. These were mediocre companies trading at incredibly low prices. He could buy them, wait for the price to correct, and sell. During this period, he compounded capital at nearly 30% annually. But as the 1960s drew to a close, the market became speculative and expensive. The Nifty 50 era was beginning, where investors bought growth stocks at any price. Buffett could no longer find bargains. True to his intellectual honesty, he did the unthinkable. He dissolved the partnership. He wrote to his partners in 1969, essentially saying, "I can no longer find opportunities that meet my criteria. I am not willing to play a game I do not understand." He returned their money. This act of integrity cemented his reputation. He would rather stop playing than play recklessly. Berkshire Hathaway, compounding conglomerate. Upon dissolving the partnership, Buffett distributed shares of a textile company he had acquired to his partners. That company was Berkshire Hathaway. The story of Berkshire Hathaway is an irony. It was, by Buffett's own admission, a mistake. He had bought into the New England textile mill in the early 1960s, thinking it was a classic cigar butt, trading below its working capital. He expected the price to pop so he could sell. But the textile business was dying. It was capital-intensive, faced cheap foreign competition, and had no pricing power. However, having taken control of the company, Buffett refused to let the cash flow die with the textile mills. He used the dwindling cash flows from the textile operations to buy into other businesses, specifically insurance. He bought National Indemnity in 1967. This was the turning point. The pivot from a textile manufacturer to a compounding conglomerate changed financial history. Why insurance? The answer lies in the concept of float. When you pay an insurance premium, you pay it up front. The insurance company holds that money until a claim is potentially filed years later. In the interim, that money, the float, is available to be invested. Buffett realized that if he could underwrite insurance policies at a break-even level, meaning premiums equaled claims and expenses, he essentially got to hold vast sums of other people's money for free. He could then invest this free leverage into stocks and private businesses. Unlike a bank loan, which charges interest and has a due date,
float, if managed correctly, has a negative cost of capital and no immediate repayment date. Buffett turned Berkshire Hathaway into an investment vehicle disguised as an insurance company.
Over the next decades, he stopped buying cigar butts. Influenced by his partner Charlie Munger, he began buying wonderful businesses at fair prices. He acquired See's Candies, the Buffalo News, Nebraska Furniture Mart, and bought massive stakes in public companies like Coca-Cola and American Express. Berkshire Hathaway became a collection of high-quality, cash-generating businesses. The cash from See's Candies was not used to buy more chocolate factories. There wasn't enough demand for that. Instead, it was sent to Omaha, where Buffett reallocated it into the next best opportunity. This is the ultimate pattern of Berkshire. It is a capital reallocation machine. It takes cash from mature, slow-growing industries and funnels it into high-growth, high-return opportunities. It acts as an internal capital market, more efficient than Wall Street because there are no tax consequences or transaction fees when moving money from one subsidiary to another. Today, Berkshire Hathaway is a fortress. It holds hundreds of billions in cash and owns distinct businesses ranging from railroads to energy to retail. But at its core, it remains what Buffett designed it to be, a vessel for compounding capital through rational allocation. The world's greatest investor is not a title Buffett won in a lottery. It is the result of a lifetime of constructing a vehicle, Berkshire, that optimized his specific skills. He built a machine that allowed him to play the long game while everyone else was sprinting. Chapter 2. The Education of Warren Buffett. Genius does not emerge in a vacuum. To understand the sophisticated investor Warren Buffett became, we must first understand the student he was. His philosophy is not a single invention, but a synthesis, a unique blending of 4 distinct influences that on the surface might seem contradictory. He took the moral rigidity of his father, the quantitative discipline of Benjamin Graham, the qualitative vision of Philip Fisher, and the multidisciplinary rationality of Charlie Munger, and forged them into a single cohesive worldview. This chapter explores the intellectual lineage of the world's greatest capital allocator. Howard Homan Buffett, earliest influence. The first, and perhaps most profound influence, was his father, Howard Buffett. While Benjamin Graham gave Warren a toolkit for the market, Howard gave him a compass for life. Howard was a stockbroker, but he was also a 4-term United States congressman with a staunchly libertarian streak. He was a man of unyielding principle. In an era of political deal-making, Howard was known for refusing to compromise his beliefs even if it meant standing alone. He was an old right conservative who opposed the New Deal, distrusted government intervention in the economy, and advocated for the gold standard. But the lesson Warren absorbed was not necessarily political, it was psychological. Howard Buffett taught his son the concept of the inner scorecard. Most people operate on an outer scorecard. They crave external validation. They worry about what the neighbors think, what the press says, and whether they are keeping up with the herd. In the investment world, the outer scorecard leads to trend following. It makes you buy tech stocks in 1999 because everyone else is, or sell in a panic in 2008 because everyone else is screaming fire. Howard lived by an inner scorecard. He did what he believed was right, regardless of popularity. He taught Warren that if you are right about the facts and right about the reasoning, you don't need the crowd to agree with you. In fact, the crowd's disagreement is often a signal that you are onto something. This trait, the ability to stand apart from the crowd without anxiety, is the psychological bedrock of Warren Buffett's investing. When he bought American Express during the salad oil scandal, or when he bought stocks during the 2008 financial crisis, he was channeling Howard Buffett. He was comfortable being a minority of one. Benjamin Graham, developing an investment methodology. If Howard provided the temperament, Benjamin Graham provided the mechanics. In 1949, Warren Buffett picked up a copy of a book titled The Intelligent Investor. He has often said that reading it was the luckiest moment of his life. Graham, a professor at Columbia University and a professional money manager, is considered the father of value investing. Before Graham, investing was largely viewed as speculation, a dark art of reading ticker tapes and guessing momentum. Graham turned it into a profession. Buffett was so taken by the book that he traveled to Columbia to study under Graham.
Graham's philosophy rested on three pillars that remain the holy trinity of value investing today.
The first pillar is that a stock is not just a piece of paper. It is a fractional ownership interest in a real business. This sounds obvious, but it is ignored by the majority of market participants who view stocks as tokens to be traded. The second pillar is the concept of Mr. Market. Graham personified the stock market as a manic, depressive business partner. Every day, Mr. Market knocks on your door and offers to buy your interest in the business or sell you his. Some days he is euphoric and offers a ridiculously high price. Other days he is depressed and offers a ridiculously low price. Graham taught that you should not let Mr. Market's mood swings dictate your view of the business's value. Instead, you should use his moods to your advantage. You are free to ignore him. The third and most important pillar is the margin of safety. This is the engineer's concept applied to finance. If you build a bridge that needs to hold a 10-ton truck, you don't build it to hold exactly 10 tons. You build it to hold 30 tons. In investing, if you calculate a business is worth $10 a share, you don't buy it at $9, you buy it at $5. That gap, the margin of safety, protects you against errors in your own calculation or unforeseen bad luck. Graham's specific method focused on what Buffett later called cigar butts. Graham looked for companies that were statistically cheap, often trading for less than the cash they had in the bank. They might be terrible businesses with no future, but if they were cheap enough, there was a puff of profit left in them. Buffett mastered this. He became an expert at scouring financial statements for these statistical anomalies. It was a quantitative, defensive approach designed to prevent loss. Philip Fisher, discerning a good business. As Buffett's capital grew, the cigar butt strategy began to fail him. You cannot scale a strategy that relies on buying tiny, obscure, dying companies. He needed a new way to think.
Answer Philip Fisher. Fisher was the antithesis of Graham. While Graham was a quant who cared only about the balance sheet, Fisher was a qualitative researcher who cared about the future. Fisher wrote the influential book Common Stocks and Uncommon Profits. Fisher argued that you could make far more money by finding a truly great company and holding it for decades than by trading cheap stocks. He was interested in growth stocks, but unlike the speculators, he analyzed growth through a rigorous investigation he called the scuttlebutt. The scuttlebutt method involved talking to everyone except the stock market. Fisher would talk to a company's competitors, its suppliers, and its former employees. He wanted to know, does this company have a product with a competitive advantage? Does it have a management team with unquestionable integrity? Is the company organized to innovate? Graham would buy a company because its assets were cheap. Fisher would buy a company because its future earnings were going to be massive. Fisher taught Buffett that the quality of the business matters. A company with high profit margins, a dominant market position, and a brilliant management team is worth paying a premium for. This was a radical departure for Buffett. It required him to leave the safety of the balance sheet and make judgments about human behavior, brand loyalty, and technological durability. It prepared him for his greatest investments, like Coca-Cola and Apple, which Graham would have rejected as too expensive, but Fisher would have recognized as compounding machines. Charlie Munger, an intellectual perspective. The final piece of the puzzle is Charlie Munger. Munger, a lawyer by training and a fellow Omaha native, met Buffett in 1959. They became intellectual soulmates. Munger is often described as the man who pushed Buffett toward quality.
While Buffett was still tempted to buy cheap cigar butts, Munger was the voice in his ear saying, forget it. Munger's famous maxim is, it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Munger helped Buffett graduate from Graham to Fisher. He understood that time is the friend of the wonderful business and the enemy of the mediocre one. If you buy a mediocre business at a bargain, you must sell it quickly once the price corrects. If you buy a wonderful business, you can hold it forever, letting the internal compounding of the business do the work for you. But Munger brought something else, a multidisciplinary mind. He spoke of mental models. He believed that to be a great investor, you had to understand the big ideas from physics, biology, psychology, and history. You had to understand how systems work. Munger introduced the concept of Lollapalooza effects,
situations where multiple factors reinforce each other to create a non-linear result. For example, a great brand, psychology, combined with a low-cost production model, economics, and a viral adoption loop, sociology, creates a business that is unstoppable. Munger's influence turned Berkshire Hathaway from a portfolio of stocks into a collection of subsidiaries. He encouraged Buffett to take control of businesses like See's Candies, even when the price seemed high relative to book value, because the goodwill, the brand value, was underappreciated. Summary of the education. So here stands the mature Warren Buffett. He has the inner scorecard of Howard Buffett, allowing him to ignore the noise. He has the margin of safety from Benjamin Graham, ensuring he never overpays to the point of ruin. He has the scuttlebutt approach of Philip Fisher, allowing him to identify businesses with superior economics. And he has the mental models of Charlie Munger, allowing him to see the interconnectedness of the business world.
It is this specific chemical mixture, 85% Graham and 15% Fisher, as Buffett once described himself, that created the methodology we will explore in the next chapter. He did not just learn these lessons, he lived them. And as we move into the tenets of his investing, you will see how each of these four men sits at the table with him every time he makes a deal. Chapter 3. Business-Driven Investing. We have arrived at the engine room of the Berkshire Hathaway philosophy. If the previous chapters were the history and the theory, this chapter is the manual. This is where we strip away the mystical aura of the oracle and look at the hard, quantifiable criteria Warren Buffett uses to select an investment. It is critical to understand a fundamental shift in mindset before we list these criteria. Most investors look at a stock and ask, where will the price go next week? Buffett looks at a stock and asks, if I bought this entire company today and closed the stock market for 5 years, would I be happy with the results?
He does not view himself as a stock picker. He views himself as a business analyst. To that end, he has developed 12 immutable tenets, 12 hurdles that a company must clear before he will deploy a single dollar of Berkshire's capital. We group these into 4 categories: business tenets, management tenets, financial tenets, and value tenets. Let us walk through them one by one. Business tenets. The first category deals with the qualitative nature of the business itself. The first tenet is, the business must be simple and understandable. This sounds patronizingly easy, but it is the place where most professional investors fail. They conflate complexity with sophistication. They believe that if a business model is difficult to understand, like a complex derivative structure or a cutting-edge biotech firm, it must offer higher returns. Buffett believes the opposite. Complexity introduces fragility. Complexity hides risk. He operates strictly with what he calls his circle of competence. This circle is not defined by its size, but by its boundaries. It does not matter how big the circle is, it matters that you stay inside it. For Buffett, this means businesses with relatively predictable economics, insurance, banking, consumer goods, energy. If he cannot understand how a company makes money, how it will fend off competitors, and what its cash flows will look like in 10 years, he passes. He has a box on his desk labeled, "Too hard." Most of the technology boom of the late 90s went into that box. He missed the gains, but he also missed the crash. The second tenet is, the business must have a consistent operating history. Buffett does not like turnarounds. As he famously said, turnarounds seldom turn. He is not interested in a company that is changing its business model or recovering from a crisis. He wants a company that has been doing the same thing successfully for decades.
He's looking for a track record that proves the business model survives different economic cycles. He wants to see how the company performed in high inflation, low inflation, recession, and boom. A consistent history suggests a durable competitive advantage. The third tenet is, the business must have favorable long-term prospects. Here, we talk about the moat. A castle is only as good as the moat that surrounds it. In business, the castle is the economic engine, and the moat is the competitive advantage that protects high returns on capital. This could be a brand moat like Coca-Cola. It could be a low-cost moat like Geico or Costco. It could be a switching cost moat where it is too painful for customers to leave. Buffett looks for businesses where the moat is widening, not narrowing. If a business is a commodity, meaning the customer buys solely on price, it has no moat. Buffett avoids commodities unless he can be the lowest cost producer. Management tenets.
Once a business passes the structural tests, Buffett looks at the people running it. This is tricky because you cannot quantify human behavior on a spreadsheet. However, Buffett looks for 3 specific traits. The 4th tenet is management must be rational. Rationality in Buffett's world is almost entirely about capital allocation. When a company makes a profit, the CEO has a choice. They can reinvest that money back into the business, or they can return it to shareholders via dividends or buybacks. A rational manager only reinvests money if it can generate a high return on capital. If the business is mature and cannot grow efficiently, like a newspaper in a shrinking market, a rational manager sends the cash home to shareholders. An irrational manager keeps the money to build an empire, buying unrelated businesses just to make the company look bigger. Buffett studies how CEOs have spent money in the past. Did they buy back stock when it was cheap or when it was expensive?
Their rationality is his safety valve. The 5th tenet is management must be candid with its shareholders. Buffett reads the annual reports. He is not looking for marketing fluff, he is looking for honesty. Does the CEO admit mistakes? When a division fails, do they explain why, or do they bury the numbers in the footnotes? He specifically looks for the reporting of failure. If a CEO claims that every year is a record-breaking success, they are lying. Business is hard. Buffett wants a partner who treats him like a co-owner, sharing the bad news as quickly as the good. The 6th tenet is management must resist the institutional imperative. This is a fancy way of saying don't be a lemming. The institutional imperative is the tendency of corporate managers to imitate the behavior of other managers, no matter how foolish. If competitor A buys a jet, competitor B buys a jet. If everyone is doing a merger, we must do a merger. Buffett looks for managers who are independent thinkers, who are willing to look foolish in the short term to be right in the long term. This aligns with his own inner scorecard. Financial tenets. If the business is good and the management is solid, we move to the numbers. But we do not look at the numbers the way Wall Street does. The 7th tenet is focus on return on equity, not earnings per share. Wall Street obsesses over EPS, earnings per share. But EPS can be manipulated. A company can borrow money to buy back stock, inflating EPS while making the company riskier. Buffett focuses on return on equity, ROE. This measures how efficiently management is using the money shareholders have left in the business. He wants to see high ROE with low or no debt. A company that generates high returns only because it is highly leveraged is a fragility trap.
The 8th tenet is calculate owner earnings. This is one of Buffett's most significant contributions to financial analysis. GAAP accounting, the standard rules companies follow, requires them to list net income. But net income can be deceptive. It includes non-cash charges. Buffett calculates what he calls owner earnings. The formula is roughly net income plus depreciation and amortization minus capital expenditures required to maintain the business. Why does he add back depreciation? Because it is a non-cash charge. But why does he subtract capital expenditures? Because a business that must spend all its profit just to stay alive is not generating real cash for the owner. He wants to know the distributable cash, the money the owner can actually take out of the business without hurting its operations. This is the true yield of the asset. The 9th tenet is look for high profit margins. This connects back to the moat. A company with high profit margins usually has a monopoly-like position. If they have to cut prices to survive, their margins erode. Buffett looks for companies that can raise prices without losing volume. He is allergic to businesses with high fixed costs and low margins, like airlines historically, or commodity steel. The 10th tenet is the $1 premise. This is a test of retained earnings. If a company keeps $1 of profit instead of paying it out as a dividend, that dollar must create at least $1 of market value over time. If a company retains $1 billion over 10 years, its market capitalization should have risen by at least $1 billion. If it hasn't, management has destroyed value. This is the ultimate scorecard for capital allocation. Value tenets. Finally, we arrive at the price. A great business can be a terrible investment if you pay too much for it. The 11th tenet is, what is the value of the business? Buffett determines value using a discounted cash flow analysis. He estimates the future cash flows, owner earnings, the business will generate over its life, and discounts them back to the present using a specific interest rate. This gives him the intrinsic value. Note that he uses the long-term U.S. government bond rate as his discount rate, the risk-free rate. He does not add a risk premium because he believes his risk is eliminated by buying the right business and management, not by tweaking the math. The 12th tenet is buy at attractive prices. Once he knows the intrinsic value, say $100 per share, he waits. He does not buy at 95, he buys at 60. He demands a margin of safety. This gap is what allows him to sleep at night. If his calculation is slightly off, or if the economy tanks, the low price protects his principal. An intelligent investor. When you combine these 12 tenets, you get a holistic filter. It is a filter that rejects 99% of public companies. It rejects the complex, the indebted, the dishonest, and the expensive. It leaves you with a tiny list of superstocks. These are companies like Coca-Cola in 1988 or Apple in 2016. They are understandable, run by rational people, generating massive owner earnings, and trading at a discount to their future cash flows. Investing in this light is not gambling. It is not even really trading. It is the act of allocating capital to the highest probability outcomes. It turns the stock market from a casino into a shopping mall where you wait for the highest quality merchandise to go on sale. Chapter 4. Common Stock Purchases. We now move from the classroom to the laboratory. Theory is useless without application. In this chapter, we will examine how Warren Buffett applied his 12 tenets in the real world. We will dissect 5 specific investments: the Washington Post, Geico, Capital Cities ABC, Coca-Cola, and his most recent massive wager, Apple. These are not random picks.
They represent different eras of his evolution and different aspects of his philosophy. Some were value plays, some were growth plays, and some were bets on management. But all share the same DNA. They were rational decisions made when the rest of the world was irrational. The Washington Post Company. Let us travel back to 1973. The United States was in turmoil. The Watergate scandal was unraveling the Nixon presidency. Inflation was soaring, and the stock market was crashing. In the midst of this fear, Warren Buffett began buying shares of the Washington Post Company. By most standards, it looked risky. The newspaper was in a political war with the White House. But Buffett looked at the business, not the headlines. He saw a franchise. A newspaper in a major city was, at that time, an unregulated toll bridge. If you wanted to advertise to the citizens of Washington, D.C., you had to pay the Post. It had pricing power. It could raise advertising rates every year without losing customers. Buffett applied his valuation tenets. He calculated the intrinsic value of the company, the value of its newspapers, its television stations, and its real estate, to be roughly $400 to $500 million. Yet, because of the market panic, the total market value of the company was only $80 million. He was buying $1 for 20 cents. It was a classic Graham value play, but with a Fisher twist. The quality of the asset was pristine. He also bet on the management. Katharine Graham, the publisher, was nervous and inexperienced, but she was honest and fiercely protective of the paper's journalistic integrity. Buffett became her mentor, teaching her about capital allocation. Under his guidance, the Post bought back massive amounts of its own stock, increasing Buffett's ownership percentage without him spending another dime. By the time he held the stock for decades, the return was more than 100 times his initial investment. Geico Corporation.
If the Post was a media play, Geico was a lesson in the durability of a low-cost model. Buffett's relationship with Geico began in 1951, when he visited their headquarters on a Saturday and pounded on the door until a janitor let him in. He met Lorimer Davidson, who spent 4 hours explaining the insurance business to him. Buffett fell in love with the model. Geico sold insurance directly to the customer, bypassing agents. This gave them a structural cost advantage of roughly 15 to 20% over competitors. In a commodity business like auto insurance, being the low-cost producer is the ultimate moat.
However, in 1976, Geico flirted with bankruptcy. Management had gotten sloppy. They underpriced their policies and relaxed their underwriting standards to grow fast. Losses mounted. The stock collapsed from $61 to $2. While the market saw a bankruptcy, Buffett saw a temporary, fixable problem in a fundamentally sound business. The core engine, the direct-to-consumer model, was still intact. They just needed disciplined management to fix the underwriting. Buffett invested heavily when the company was on the brink. He bet on the new CEO, Jack Byrne, to cut costs and restore sanity. It worked. Geico survived and thrived. Eventually, Buffett liked the business so much he bought the entire company. Today, Geico is a wholly owned subsidiary of Berkshire Hathaway, generating billions in float that Buffett invests elsewhere. It is the engine that powers the Berkshire machine. Capital Cities/ABC. In 1985, we see a shift towards betting on superior management. Capital Cities was a media company run by Tom Murphy and Dan Burke. These two men were arguably the best managers Buffett had ever seen. They were cost-cutting fanatics who ran a decentralized, efficient operation. When Capital Cities wanted to acquire the much larger ABC network, they needed cash. Buffett agreed to provide $500 million in financing to help them do the deal. This was unusual. Buffett typically bought stocks, not entire deals, but he was essentially paying a premium to be in business with Tom Murphy. He recognized that Murphy would apply his lean management style to the bloated ABC network, unlocking massive value. He was right. The merger created an industry giant, and Buffett's stake grew enormously. This investment highlights the management tenet. Sometimes the moat is the person sitting in the CEO's chair. The Coca-Cola Company. Now we arrive at 1988, the investment that defined Buffett for a generation. After the crash of 1987, the market was skittish.
But Buffett began buying Coca-Cola with both hands, eventually investing over $1 billion, a quarter of Berkshire's portfolio at the time. Why Coke and why then? The company had been around for a century. The genius was in recognizing a change in the business dynamics. Under new management, Coke had sold off its low-margin bottling operations and focused on selling the syrup. This reduced capital requirements and exploded profit margins. Buffett saw the inevitable. He noted that Coke had no effective competitor other than Pepsi, and its product was sold in every country in the world. As the global population grew and wealth increased, people would drink more Coke. It was a royalty on the hydration of the human race. Crucially, he paid a price that Benjamin Graham would have hated. He paid roughly 15 times earnings. Graham preferred single digits, but Munger and Fisher's influence was now dominant. Buffett realized that 15 times earnings was cheap for a company that would grow its earnings at a double-digit rate for the next 20 years. He stopped looking for a bargain price and paid a fair price for a wonderful business. Apple Inc. Updated case study. Fast forward to 2016. The financial world was shocked when Berkshire Hathaway began buying Apple. For decades, Buffett had avoided technology, claiming it was outside his circle of competence. He said he couldn't predict which tech companies would survive. So, why Apple? And why did it become his largest holding ever? The answer is that Buffett did not view Apple as a technology company. He viewed it as a consumer goods company. He saw that the iPhone had become a utility, as essential to modern life as electricity or the car. He looked at the switching costs. Once a user is in the Apple ecosystem with their photos, messages, and apps, it is incredibly painful to switch to Android. This created a sticky customer base. He also saw the pricing power. Apple could raise the price of the iPhone to over $1,000, and people would still line up to buy it. Furthermore, Apple was managed rationally. Tim Cook was using the company's massive cash pile to buy back shares at a ferocious pace. This increased Berkshire's ownership stake every year without Buffett doing a thing. Apple fits all the tenets. Simple to understand, it sells a premium phone, consistent history, rational management, high return on equity, and a wide moat. It is the modern-day Coca-Cola. The value of retained earnings. What ties Washington Post, Geico, Capital Cities, Coke, and Apple together? Retained earnings. In every single case, these companies were highly profitable, but instead of paying out all those profits as dividends, they retained a large portion of them to reinvest. The Washington Post bought back stock. Geico grew its marketing budget to capture more market share. Capital Cities paid down debt and bought more stations. Coke expanded into international markets like China and India. Apple built its services business and bought back shares. Buffett's genius was realizing that if a company can retain $1 of earnings and reinvest it at a high rate of return, that dollar is worth more inside the company than in his pocket. He did not want dividends. He wanted capital appreciation. By holding these stocks for decades, he allowed the magic of compound interest to work uninterrupted. He did not sell Coke when it went up 50%. He held it while it went up 2,000%. This is the secret of the portfolio: inactivity. The big money is not in the buying and selling, but in the waiting. Chapter 5. Managing a portfolio of businesses. We have spent a great deal of time discussing how to pick a single stock, but an investor rarely holds just one. The question now becomes, how do you combine these choices into a cohesive whole? How many stocks should you own? How long should you hold them?
And how do you measure if you are winning? In the world of institutional finance, there is a rigid playbook for portfolio management. Warren Buffett took that playbook and threw it in the trash. In this chapter, we are going to explore why he believes the standard advice on diversification is not just wrong, but dangerous for the dedicated investor. Portfolio management today, a choice of two. If you walk into a typical financial advisor's office today, you will generally be presented with two main options for managing money. The first is active management. This is the traditional mutual fund model. You pay a manager a fee to buy and sell stocks, trying to beat the market. The problem, as we will discuss later, is that most active managers fail to beat the market after fees. They churn stocks, rack up tax bills, and hug the index because they are terrified of underperforming. The second option, which has gained massive popularity, is passive management, or indexing. This is where you buy the entire haystack. You buy the S&P 500. You accept that you will not beat the market, but you also won't underperform it. You get the market average with very low fees.
Buffett has often said that for the vast majority of people, the know-nothing investors, indexing is the best choice. If you do not have the time or the interest to study businesses, you should simply ride the growth of American business as a whole. But what if you are not a know-nothing investor? What if you are willing to do the work? The financial industry tells you that even then, you must diversify widely to reduce risk. They tell you to hold 50, 60, or 100 stocks to smooth out the bumps. Buffett disagrees. He offers a third path. A third choice, focus investing. This third path is what we call focus investing. It is the antithesis of modern portfolio theory. Modern theory says diversify to reduce risk. Buffett says diversification is protection against ignorance. If you know what you are doing, broad diversification makes little sense. Think about it logically. If you have done the deep work to identify the 5 best businesses in the world, businesses with wide moats, great management, and fair prices, why would you put money into your 20th favorite idea? Why would you sell a winner to buy a mediocrity just to balance your portfolio? Focus investing demands that you concentrate your capital on your highest conviction ideas. Buffett has famously said that an investor should act as if they have a punch card with only 20 slots for their entire lifetime. Every time you buy a stock, you punch a hole. If you only had 20 bets, you wouldn't waste them on a hot tip or a gamble. You would research deeply and bet heavily. At Berkshire Hathaway, the equity portfolio has historically been incredibly concentrated. Often, the top 5 holdings account for over 60 or 70% of the total value. This concentration means that if one of those companies performs exceptionally well, it moves the needle for the whole portfolio. Conversely, if one fails, it hurts.
But Buffett argues that the risk of holding a few things you understand is lower than the risk of holding many things you do not. The super investors of Buffettville. Critics argue that Buffett is a statistical outlier, a lucky coin flipper. They say his success cannot be replicated. To counter this, we look to a famous speech Buffett gave at Columbia University titled The Super Investors of Graham and Doddsville. In this speech, he presented a group of investors who all studied under Benjamin Graham. They were different people, managing different portfolios in different places. One bought big companies, another bought small ones. One held for years, another traded more frequently. But they all shared the same philosophy: buying businesses for less than they were worth. And the result? They all crushed the market over long periods. This proves that the Buffett way is not a cult of personality. It is an intellectual framework. These super investors did not mimic each other's picks. They mimicked each other's thinking. They were all focus investors in their own way. They bet big when the odds were in their favor and sat on their hands when they were not. The lesson here is that you do not need to be Warren Buffett to succeed. You need to be a resident of this intellectual village. You need to accept that the market is there to serve you, not to instruct you, and that price and value are two different things. 3,000 focus investors. Let us conduct a thought experiment. Imagine there are 3,000 investment managers. We ask them to construct a portfolio. Most will build a closet index, a portfolio that looks very similar to the S&P 500 because they are afraid of being fired if they deviate too far and fail. But a small subgroup, the focus investors,
will build portfolios that look nothing like the index. They might hold only 10 stocks. Here is the mathematical reality. In the short run, the focus investor will experience higher volatility.
Their portfolio might drop 20% when the market is only down 10, but in the long run, the focus investor has the mathematical edge. By concentrating on their best ideas, the ones with the highest probability of success, they allow the power of compounding to work on their most efficient assets. The 3,000 conventional managers are playing a game of career risk management. The focus investor is playing a game of wealth maximization. You have to decide which game you are playing. You cannot play both. A better way to measure performance. If you adopt focus investing, you must change how you keep score. The world measures performance by price change. If the stock goes up, you are winning. If it goes down, you are losing. Buffett measures performance by operating results. He looks at the look-through earnings of his portfolio. What does this mean? If Berkshire owns 10% of Coca-Cola, Buffett calculates that he owns 10% of Coca-Cola's profit. Even if Coca-Cola pays a small dividend, Buffett mentally claims his share of the retained earnings that stay inside the company. He asks, did the look-through earnings of our portfolio go up this year? Did our companies become more profitable? If the earnings went up, the value went up, regardless of what the stock price did that year. Eventually, the stock price will catch up to the earnings, but in the short term, they can diverge. A focus investor celebrates when the stock price of a great company goes down because it allows them, or the company itself via buybacks, to buy more of the earnings stream at a cheaper price. High active share investing. This brings us to a modern metric called active share. This measures how different a portfolio is from the benchmark index. A fund with zero.
Academic studies have shown that managers with high active share, meaning they truly pick their own stocks and ignore the index weights, are the only ones who have a chance of outperforming after fees.
Buffett is the ultimate high-active share manager. He does not own a stock just because it is in the S&P 500. He owns it because it meets his tenets. He is comfortable looking different. And this is the final lesson of portfolio management. You must be comfortable with lumpy results. There will be years where you underperform. During the dot-com bubble of 1999, Buffett looked like a dinosaur. His portfolio was flat while tech stocks soared. He was mocked on the covers of magazines. But he did not change his portfolio to chase the trend. He stuck to his focus. When the bubble burst, he was the last man standing. Focus investing requires the psychological strength to look wrong in the short term so you can be right in the long term. Chapter 6. It's not that active management doesn't work. We now enter the most controversial territory of the investment world. For decades, there has been a cold war between the practitioners of finance, people like Warren Buffett, and the academics of finance, the professors at major business schools. If you go to a top-tier MBA program, you will likely be taught that what Warren Buffett does is statistically impossible. You will be told that the market is efficient, that stock prices always reflect all available information, and that trying to pick undervalued stocks is a fool's errand. This chapter is a defense of active management, but with a major caveat. It is a defense of a specific kind of active management. It explains why the academic theories are elegant but flawed, and how Buffett operates in a parallel universe that allows him to see value where others see only efficient pricing. High priests of modern finance. In the mid-20th century, a new priesthood emerged in the financial world. These were not traders in the pits of the exchange, they were economists in the ivory towers of universities. They sought to turn investing into a hard science, like physics.
They developed modern portfolio theory, MPT, and the capital asset pricing model, CAPM. These theories rely heavily on the Greek letter beta. Beta measures how much a stock moves in relation to the overall market. If the market goes up 10% and a stock goes up 20%, it has high beta. The academics defined this volatility as risk. Buffett thinks this is nonsense. To him, volatility is not risk. Volatility is opportunity. Risk, he defines, is the probability of permanent loss of capital. If a stock crashes by 50% because of a temporary panic, the academics say it has become riskier because its volatility has spiked. Buffett says it has become less risky because you can now buy the same asset at a lower price, increasing your margin of safety. The high priests equate risk with price fluctuation. Buffett equates risk with business ignorance. This fundamental disagreement is why the academic community and the Buffett community talk past each other. The academics are measuring the motion of the ship. Buffett is measuring the structural integrity of the hull. Efficient market hypothesis. The crown jewel of academic finance is the efficient market hypothesis, EMH. In its strongest form, it states that at any given moment, a stock's price is fair and correct.
Because millions of smart investors are constantly buying and selling, all information is instantly baked into the price. Therefore, no one can consistently beat the market, and anyone who does, like Buffett, is just a statistical anomaly, a lucky monkey typing Shakespeare. Buffett's rebuttal to this is scathing and hilarious. He points to the super investors of Graham and Doddsville. If the market were truly efficient, how could a group of investors who all follow the same philosophy, value investing, all beat the market by massive margins over 50-year careers? If it were just luck, the winners would be randomly distributed. They wouldn't all come from the same intellectual village.
Buffett acknowledges that the market is often efficient. Large-cap stocks are usually fairly priced. But he argues that the market is not always efficient. It is subject to fear and greed. When the market crashed in 1987 or 2008, the businesses didn't lose half their value overnight. The prices did. The efficient market hypothesis assumes that investors are rational computers. Buffett knows that investors are emotional humans. As long as humans run the market, there will be inefficiencies to exploit. Investment and speculation. Understanding the difference. To navigate this landscape, we must draw a hard line between two words that are often used interchangeably: investment and speculation. In the eyes of the media, everyone buying a stock is an investor. To Buffett, most of them are speculators. The distinction comes from Benjamin Graham. An investment is an operation that, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculation. If you buy a stock because you think the price will go up next week because of a chart pattern or a rumor, you are speculating. You are betting on the behavior of other people. You are playing the greater fool game. If you buy a stock because you have analyzed the cash flows and determined that the business will generate a return on your capital over 10 years, you are investing. You are betting on the productivity of the asset. Buffett has a simple test. If you buy a stock and then hope the price goes up the next day, you are a speculator. If you buy a stock and hope the price goes down the next day so you can buy more, you are an investor. The speculator loves high prices. The investor loves low prices. Investing in a parallel universe. Ultimately, Warren Buffett operates in a parallel universe to the rest of Wall Street.
In the standard universe, the one inhabited by mutual fund managers and day traders, the focus is on macroeconomic predictions, interest rates, GDP, quarterly earnings beats or misses, beta, alpha, and Sharpe ratios, momentum, and sector rotation. In Buffett's universe, none of those things exist. He literally does not have a computer in his office to check stock prices. He does not pay attention to the Federal Reserve. In his universe, the focus is on the durability of the moat, the rationality of capital allocation, the generation of free cash flow, the price paid relative to intrinsic value. The reason active management doesn't work for most professionals is that they are living in the first universe. They are trying to predict the unpredictable, short-term price moves, using tools that measure the wrong things, volatility. They are playing a game they cannot win, burdened by fees and short-term incentives. Buffett wins because he refuses to play that game. He is playing a game of business arbitrage. He buys dollar bills for 50 cents and waits for the market to eventually agree with him. It is not that active management is dead. It is that rational active management is rare. Chapter 7, Money Mind. We arrive now at the final chapter of our study. We have dissected the mechanics of the Buffett method, the math, the ratios, the business analysis. But if we stopped there, we would be missing the most critical component. You can teach a computer to calculate intrinsic value. You can teach a computer to filter for return on equity. Yet no computer has ever replicated Warren Buffett's success. Why? Because investing is not just an act of calculation, it is an act of character. Robert Hagstrom calls this the money mind. It is the psychological architecture that allows an investor to use the tools we have discussed without cutting themselves. It is the ability to make decisions based on probability rather than emotion. In this chapter, we explore the man behind the method and the institution he built to house it. Sportsman, teacher, artist. To understand Buffett's longevity, you must understand his motivation. If he were driven by money, he would have retired 50 years ago. He has more wealth than he could spend in 1,000 lifetimes. So, why does he still go to the office every day? Why, at an advanced age, is he still reading annual reports? He is a sportsman. He views the market as a great game. It is a competitive arena where he pits his intellect against the collective wisdom of the world. The money is not the prize. The money is the scorecard. It tells him if he played the game well. He famously says he tap dances to work. This joy is a competitive advantage. While other managers are burned out, stressed by quarterly targets, and looking for an exit, Buffett is having the time of his life. He plays the game for the love of the game, which allows him to play it better and longer than anyone else. He is a teacher. Buffett has never written a book. Instead, he writes his annual letters to shareholders. These letters are not the dry, legalistic documents produced by most corporations. They are essays. They are educational tools. He treats his shareholders not as faceless investors, but as partners. Specifically, he writes as if he is writing to his sisters Bertie and Doris. He wants them to understand what they own. He explains his mistakes as clearly as his successes. By educating his shareholder base, he cultivates a specific type of investor, one who is patient, rational, and loyal. This gives him the permanent capital he needs to invest for the long term. He is an artist. We rarely associate finance with art, but Buffett views capital allocation as his canvas. The structure of Berkshire Hathaway, a collection of disparate businesses held together by a central allocation engine, is a creative act. He paints with capital. He sees a flow of cash from a candy company and uses it to paint a new position in an airline or a tech giant.
It is fluid, dynamic, and entirely his own creation. Berkshire Hathaway, an American institution. The result of this sportsman, teacher, artist approach is Berkshire Hathaway itself. It is not just a company, it is a corporate anomaly. Consider its headquarters. A company of its size, employing hundreds of thousands of people across dozens of subsidiaries, usually has a headquarters with thousands of staff, lawyers, HR departments, and public relations teams. Berkshire Hathaway's headquarters in Omaha employs roughly 25 people. This is not an accident. It is a philosophy. It is the philosophy of radical decentralization. Buffett trusts his managers. He buys a business, leaves the management in place, and tells them, run it as if you own it. Run it as if it is the only asset your family has, and run it as if you cannot sell it for 100 years. He does not ask for meetings. He does not demand budgets. He asks only that they send the cash they do not need to Omaha and that they protect the reputation of the company. This structure attracts a specific type of manager, the wealthy entrepreneur who loves their business but hates the bureaucracy of public markets. They sell to Buffett because they know he will let them keep painting their own picture. Berkshire Hathaway is built on trust. In a financial world dominated by compliance officers and complex contracts, Buffett does deals on a handshake. He has built an institution that proves that integrity and trust are not just moral virtues, they are economic assets. They reduce friction. They speed up execution. They make Berkshire the first call for anyone looking to sell a great business. Appendix A. Berkshire's performance versus the S&P 500 Index, 1965 to 2022. As we conclude, we must look at the scoreboard. Appendix A details the raw data of this experiment. From 1965 to 2022, the S&P 500, with dividends included, delivered a compounded annual gain of roughly 9.9%. This is a fantastic result.
It is the engine of American capitalism. A dollar invested in the index grew significantly over that period. However, Berkshire Hathaway's per-share market value grew at a compounded annual rate of 19.8%. The difference between 9.9% and 19.8% may not sound earth-shattering in a single year, but when compounded over 58 years, the divergence is astronomical. The overall gain for the S&P 500 was roughly 24,000%. The overall gain for Berkshire Hathaway was over 3,700,000%. This is the difference between a comfortable retirement and dynastic wealth. It is the mathematical proof that the tenets we have discussed, rationality, patience, focus, and value, are not just theories. They are the laws of financial gravity. Appendix B. Berkshire's Common Stock Portfolios, 1977 to 2021. Appendix B tracks the evolution of the portfolio. It is a fascinating historical document. In the 1970s, you see the heavy weighting in media and consumer brands, the Washington Post, Geico. In the 1980s and 90s, you see the inevitable consumer giants, Coca-Cola, Gillette. In the 2000s and 2010s, you see the shift toward heavy industry and finance, Burlington Northern Santa Fe, the railroad,
Bank of America, and finally, you see the pivot to modern tech utility, the massive stake in Apple. The names change, the industries change, but the criteria never change. In every decade, Buffett is looking for the same thing: a simple business with a moat, run by able people at a fair price. Conclusion: we have reached the end of the Warren Buffett way. If you take one thing from this journey, let it be this: investing is simple, but it is not easy. It is simple because the principles are straightforward. Buy good businesses, don't overpay, think long term. It is not easy because the world is noisy. The market will scream at you to sell when you should buy. The experts will tell you that value is dead. Your own emotions will try to sabotage you.
Warren Buffett's legacy is not his money. His legacy is his mind. He has given us a blueprint for rationality in an irrational world. He has shown us that you can win without cheating, without speculating, and without compromising your integrity. The path is open to anyone willing to walk it. You do not need billions of dollars to start. You just need to shut out the noise, look at the business, and wait for the fat pitch. Thank you for listening to these insights into the Warren Buffett way.